Hello, I'm Pat O'Hare, Editor-in-Chief of Briefing.com's Investor Service. In this Learning Center segment, we will be discussing stock buybacks. The stock buyback is conducted by a company for a variety of reasons. The main selling point is that it is a means of bolstering shareholder value. For some clarity on that point, remember that stock prices are driven by earnings growth. When a company buys back stock, there should be fewer shares in the divisor for computing earnings per share growth. That being the case, EPS growth will be higher than it would have been otherwise if stock had not been repurchased. The higher growth rate should increase demand for the stock, which should drive its price higher and thus bolster shareholder value. Stock buyback, for all intents and purposes, is an indirect way of returning cash to shareholders, whereas the payment of dividends provides a direct return of cash to shareholders. Now, stock buybacks are also conducted to help offset the dilution that occurs with the exercise of stock options or the issuance of stock to acquire another company. If a company did not buy back stock and options were exercised or new stock was issued, there would be more stock outstanding, which would have the opposite effect of lowering the EPS growth rate. It is not unusual to hear stock buyback announcements at the time a company reports a disappointment that will inevitably drive a stock price lower. Making a buyback announcement at such a time is an attempt to communicate a belief that the company sees value in the stock price. Hopefully, an affirmation of that value will help stem the selling interest. An important caveat with respect to stock buybacks is that companies are under no obligation to carry them out in accordance with the timeline and dollar amount that is first communicated. The market accepts this fact and won't necessarily penalize a company if a buyback is not carried out according to plan. However, when a company cuts its dividend or eliminates its dividend altogether, its stock is often penalized, as that act is considered to be a worrisome signal about the company's operating condition. Mindful of this, buyback announcements are typically heard more often than dividend increases, which are more damaging to retract. That wraps up our segment on share buybacks. Thanks for listening.